Hello, everyone, and thank you for joining us today. Welcome to this fun deep dive live, where we will be discussing the Simplify Gamma Emerging Market Bond Fund, ticker GAEM. We like to pronounce that GAM, and hopefully we'll be answering some of your questions about the fund and what we're doing in it. Today's discussion is for educational purposes only. We invite you to submit any questions you have through the Q&A function at the bottom of your Zoom screen. I'm Chris Getter. I am a portfolio manager and strategist here at Simplify. Joining me from the Dominican Republic is Santiago Navio. Santi, would you mind introducing yourself to our audience?
Glad to be here, Chris, and thank you. As the executive chairman for Gamma, I provide leadership, vision, strategy, and investment knowledge to the board of Gamma International Bank and its subsidiaries. My background is in fixed income, commodities, equities trading in the European and Latin space. Back in 2014, I started first as a trader, then head trader, and afterwards as a vice president for a Dominican Republic broker-dealer, overseeing a portfolio in corporates and government debt in emerging and frontier markets. We trade both hard currencies and local currencies. My roots are in Europe, with the studies both in the Netherlands and Madrid. Business and finance discipline. Thank you for again for scheduling this, and let me build your network of advisories.
Well, thank you, Santi. Also, before we get into the specifics of the strategy, can you give our listeners some background on Gamma?
Well, Gamma roots have a long established history in the Central American Caribbean space, and specifically within the Dominican Republic. We are in critical sectors of this type of economy, from agriculture, energy, hospitality to real estate. We're often compared to major global financing firms like BlackRock or Blackstone, since we're in investment banking, asset management, and of course, fixed income trading, although we do it in emerging markets and frontier markets.
Super. I want to set the stage for what we want to accomplish here. And I certainly want for us to cover how Gamma approaches investing, how you guys source ideas, how you conduct research, how you build portfolios, manage risk. I also want to dig into what is going on in some of the countries that you guys are focused on, their political, their economic outlooks, potential implications of changes here in the administration in the US, maybe whether that even matters to you. Basically, what are the big risks here? But before we get in too deep, this is a bit of an unusual offering, right? I've spent nearly all of my career in emerging market debt. I've seen countries be included in what were called convergence funds, former Soviet Union countries. As those countries matured, those funds went away. I've seen a growing corpus of Asia-focused bond funds, but this is a little bit different, in terms of an offering focused on Central America, Latin America, the Caribbean, not really something we've seen offered to retail investors before. So I think the first thing maybe we should address is why these countries and why now?
Chris, actually, this is not such a narrow space when talking about sovereign and corporate debt. We're talking about $500 billion roughly dollars. We have been growing with the region in the past 15 years. That knowledge gives us a view of the growing on issuance and expecting to keep on the following years. Many of these countries, sovereign debt and corporates, usually are not well covered by the street side. Our view is that these bonds started to trade cheap on their fundamentals.
So what gives the GAM ETF an edge in sourcing the best emerging market debt opportunities?
Well, Chris, let me give you here an analogy. Think of yourself like a real estate agent who just only works on the neighbor, but actually we live in the neighbor. We go to the butcher, we go to the grocery store, we talk to the clients. That is us in the Central American Caribbean space. Actually, we understand the real dynamic of the economy, and that's really helped us just following all the shifts in the economy. We build relations, and actually We know where the truly risk exists, and we know also where the opportunities are. We're just not analyzing from an office in New York. We're here in the neighborhood, and that gives you really a lot of confidence.
But I like the real estate analogy. And having spent so much of my time covering these countries from afar with travel to them sprinkled in, I can relate to the value of bringing local expertise into the equation. So the goal is building a portfolio with a fairly high yield, but solid, if perhaps underappreciated, credit fundamentals. And Gamma is in a very strong position, not just figuratively, but literally, to conduct the rigorous analysis you need to make sure you get that yield and you don't have it eroded by credit events. And today, the fund, for reference, yields about 8.5%. That's an average credit quality of mid double B. I would compare that to US high yield, which is yielding about 7.2% today with a credit quality of single B, so a full notch lower. So yes, GAM is delivering on that notion of higher quality, higher yielding securities in the portfolio.
Well, your statement is absolutely correct, Chris. Thank you. Thank you for bringing this overall great view up. Gamma has the right investment strategy for investors, as the goal to our main market fixed income portfolio is to generate higher yields while capitalizing and underappreciate credit fundamentals. We achieve this through a disciplined approach that combines, I would say, total macroeconomic analysis with rigorous bottom-up selection scrutiny. By focusing on any key sectors, assessing relative values across issuers, and carefully analyzing yield curves, GAM identifies opportunity with the market misprice, which often happens a lot in these kind of countries and kind of corporates. That allows us to capture attractive yields and returns without taking excessive risk. Our strategy integrates a deep understanding of the macroeconomic trends, such as monetary policy shifts, fiscal stability, geopolitical dynamics, alongside a detailed evaluation of specific fundamental issues. We assess not just the bond standalone credit quality, but also we are assessing the issuer curve, its liquidity profile, and how it compares to peers in the same sector, probably, but this dual-layered approach allows us to uncover mispriced assets that others would overlook, ultimately constructing very resilient portfolios that delivers a strong income while really mitigating the downside risk. Chris, since you have spent, and since I have you on the other side, and you have spent so many years on this emerging market, and as your experience, how would the real estate investment advisor clients respond to these credit financial profiles? Are they primarily focused on the headline rating, or do they dig deeper into the underlying fundamental like we do when assessing relative value and a specific issuer by risk?
I think there's a two-part answer to that question. First, it's a challenge for investors to, as you say, like dig deeper in the credit space. I mean, just take any stock you can name, right? You've got a Yahoo Finance page, maybe you have access to research. We can debate whether or not that's good information and whether or not it even constitutes analysis. But when it comes to fixed income, number one, you've got multiple issues per issuer. So you're not looking at the stock of a company, you're looking at the bonds. You mentioned the importance of yield curve analysis. So in some cases, I think, yes, investors rely on credit ratings as a first stop. More likely, whether it's in muni bonds, government bonds, credit, whatever, they are delegating that decision to a manager, either actively or passively, to take that exposure for them. But secondarily, you mentioned the notion of familiarity with the issuers. Like, I always get the sense when we talk to clients in the US, there is some innate familiarity with a lot of the issuers, right? The banks are everybody has a bank account here in the US. The banks are the biggest issuers in the credit index. Disney's in there, Apple's in there. So these are companies that you have some exposure to. You might not be an expert in their credit statistics, but you have at least some familiarity with what's going on. maybe you have a view on how they're positioned given wherever we are in the economic cycle. But when it comes to the countries and the corporates of Latin America, Central America, the Caribbean, not so much. So maybe actually you could give us some sense for what the fundamentals look like in the region.
You really have a point there. I can add notes that really. Well, Latin and Central American Caribbean region has been overlooked in global economic discussions, with much of the focus concentrated in economies like US, China, European Union. However, this part of the world is emerging as a vital growth driver due to the diverse economic fundamentals of these countries. Tourism, manufacturing, and I would say agriculture would be the pillars that provide strong support and fiscal positioning for economic stability. Countries' contribution significantly to the GDP, like on the region, like Mexico, Dominican Republic, or Costa Rica, are some of the top destinations for global tourism and foreign exchange earnings. For example, tourism accounts for, I would say, from 8 to 10% on the Caribbean markets, such nations like Bahamas, Jamaica, and probably more in Dominican Republic. This steady growth on the sector helps sustain public finance and create jobs, which in turn, support domestic consumption and stability. On the other hand, and similarly, manufacturing in the region is poised for the growth, in particular in sectors like automotive, electronics, textile, maybe semiconductors, we'll see, but the expansion of the nearshoring and even more the friendshoring in some of the countries, driven by supply chain disruption and labor cost in China, is really boosting the overall investment in the region. Central banks in the region have had to navigate these growth drivers carefully, balancing monetary policies to support growth while managing inflationary pressures and maintaining currency stability, which is it's a must in the region. For instance, countries like Brazil and Chile have implemented policies aimed to control inflation while fostering growth, often achieving relatively moderate inflation rates in cooperation with other emerging markets. I would say that the fiscal position of many countries has improved. On average, Latin American countries' fiscal deficit decline. That's an average, obviously. You have to go case by case. Nevertheless, the region growth fundamental in tourism, manufacturing, and agriculture will continue to provide some stable foundation for fiscal positioning and overall economic stability. The region growth is not always in the global spotlight, but its positive contribution is crucially shaping the global economic landscape.
Gotcha. Since we're talking about countries here, there's a political element that we need to be mindful of when we evaluate creditworthiness, and I would argue, this can matter as much as the economics. Can you maybe just give us a quick survey of the politics in the region and maybe some of the issues that you monitor that don't, like, strictly speaking, fall under economic analysis?
Sure, Chris. All these countries, they're all democratic countries. But of course, each is unique. And you have to be on top always of looking what are the different candidates and proposing what's the new proposal of the right and the left. Also, their propositions, how would they will impact in the economy and also in the sovereign bonds. Popularity of the leaders to get reelected obviously matters for the party. And obviously they have majority in the Congress, because it really matters, to get past certain policies.
Right. And I would also mention, like, having done this, I would also mention it's not just the domestic politics that matter, but the external engagement as well. Some of these countries might either have or be in negotiations for programs with the IMF. El Salvador, Argentina come to mind, or they might receive financing from the IADB, that's the Inter-American Development Bank, They may get bilateral funding or investment from other countries, China expanding its sphere of influence, the US, et cetera. And of course, any changes in trade policy, whether that's tariffs or export-import bans, whatever, something else can have varying degrees of impact on these countries. But let's bring this back to what the team is actually doing here. Like, what is the analysis you guys are conducting, and what kind of comes out the other side?
Well, key metrics that we will review includes GDP growth, primary balance, current account, public debt, and so on, many others, but those are mainly, the key factors there. These input metrics will help us assessing how the country is doing from an economical perspective, and its potential risks and strengths. In addition, we also try to assess the political situation of the country, which always matters in this part of the world. But the following slide will provide a little bit to identify which ones of the clues are most attractive. See if it pumps up, but well, while we wait, we focus on the option adjusted spread duration ratio and the liquidity scores. Those tools are key for us when selecting which part of the curve and which bond we get into the portfolios.
Gotcha. So a lot to consider basically before we can get to the point where we say we have a well-informed view on fundamentals and then make an assessment on whether or not something is attractively priced.
Yeah, that's right, Chris. But as I mentioned before, we do more than countries. Countries is just one part of what we do. We're also very active in corporate and quasi-sovereign issues as well.
Okay, I'm glad you mentioned that, because I actually put together a chart on the corporate space here. These graphs are courtesy of Bank of America Merrill Lynch. We don't have time in the context of this call to get into individual issuers, although I think you're going to talk about an example later. But let's take a look at some averages here. What you see on these charts is for investment grade on the left and high yield on the right, the average amount of compensation per unit of leverage, again, broken down by Latin issuers and US issuers. And the message here is that pretty consistently over time, you get paid more for each unit of leverage in Latin America than either in US high yield, comparably rated companies, or in US investment grade, again, comparably rated companies. Now, far be it for me to say that leverage is the only important metric that we should use when gauging risk, but that message is pretty powerful, which says, yes, you're investing in less levered companies, and for every unit of leverage or fundamental risk, you're getting paid more spread to do that, which I think is a very powerful argument for why we should be looking beyond just the sovereign space in Latin America.
Yes, but again, we need to subject these issuers at the same sort of rigorous analysis as we do on the sovereign side. That includes looking at their financial statement, credit metrics, their ability to pay debt in dollars, especially when they're generating revenues in local currencies, and what countries they operate, which, by the way, that brings me back to the analysis of the macro country itself.
Gotcha. Thanks for the detail on that, Santiago. One of the other performance levers we can pull in GAM is foreign exchange, right? Investing in bonds that are exposed to the local currencies of these countries. And as investors in EM probably know, whether they've been in debt or equity, that local currency exposure can sometimes be a massive boost, or it can be a big disappointment. So let's dive a little bit into the logic here and also what you guys are doing in terms of analyzing the currency.
Yeah, well, GAM is not necessarily playing for a big FX appreciation, but if we can pick up meaningful yield and/or we pick up meaningful yield and at the same time price appreciation, but not necessarily. That's more likely what we're going to focus on our investment efforts. That mindset is appropriate in quite a few countries where the FX stability is an anchor for prices and managing inflation expectations.
Mm.
Furthermore, is the question on how we look at the currency. We understand what is the fiscal and the monetary policy of those countries that are keeping the FX stable, the stable FX rate. All this complete the puzzles and allow us to sleep well at night. Well, we don't have nightmares, while we have positions in local currencies.
Yeah. And just as one example, we have a position right now in notes issued by the Central Bank of the Dominican Republic. Yield on those a little north of 10%. Since the fund was launched in the third quarter of last year, the peso, DOP, has only depreciated around 4%. And the reason, getting back to what you said, is a combination of the factors you mentioned. Strong performance on the trade accounts, use of the peso as a nominal anchor, providing that price stability.
Yes, just by the way, we just closed that position, but we made a good trading profit there. But given the volatility you mentioned of the currency, it's something that we really pay a lot of attention, from the risk management point of view. The team uses a comprehensive and proactive risk approach. So, Chris, here are some specifics that I can add to the audience so they have a good sense on how we manage all these risks, this currency risk mainly. First, as we mentioned before, we only consider FX to stable currencies like the Dominican pesos, as you mentioned. What we feel, the monetary policy is focused on keeping the FX stable. And actually, it is stated by the central bank. Opposed to that would be the Mexican pesos, although it's a deeper market to hedge it, but we just don't go there. Second, we have a maximum exposure and limit on FX, and we have stop losses. And lastly, that is something that we really take into account a lot, is the seasonality of the currencies, which in some countries is a clear pattern, where is the depreciate, from year after year. You see like a clear pattern every month and after month, from one year to the other, which gives us a clear pattern, what is really going to happen in that sense, when you can have this kind of risk and when you cannot have it. Chris, perhaps you can also, help everybody that dialed in today with your American expertise, with almost 30 years in investments. What do you feel important to this investments universe when you look at emerging markets?
First, let me digest the fact that I've been in this business for almost 30 years. A lot has changed, but if I was going to try and pin down like two things that might be relevant for the conversation here, the first is in terms of the breadth of what investors can do in EM. And the keyword has to be growth. Growth in the number of countries. So when I started, if memory serves me right, I think there were 7 countries in Latin America in the index. Today there are 22, so a tripling of opportunities, and the index has similarly seen a manifold increase, the global index, a manifold increase in the number of countries. Second is growth in issuer type. So it's not just sovereigns anymore. It's sovereigns, corporates, private sector, and quasi-sovereign issuers. Third is the growth in the appeal of the local currency space as investors have reached in to capture some of those attractive yields that you mentioned. That's number one. The second thing is in what clients expect or what they should expect from the asset class. When I landed in EM in the mid-1990s, many of these countries were still concluding their Brady plan restructurings. And it's easy for me to say this with the benefit of hindsight, but the pricing of risk was just completely uncalibrated with how much fundamental risk you were actually running. So spreads for a long time, for many years, compressed and compressed. You ended up earning a lot of capital appreciation as the market kind of recognized the quality, fundamental strength of some of these economies. But over time, as credit quality has improved, I think investors should have appropriately calibrated return expectations. This is looking more like a coupon income class, less like capital appreciation asset class. Not that capital appreciation can still play a role, but it will be a smaller one. And I think that's something that people should consider, when they look at EM as a standalone opportunity, and that you evaluate the risk, the reward, the diversification potential. And many clients are still ending up, because of that, with strategic allocations to EM. But all of this, again, brings me back into what we're doing in GAM. And that's kind of harvesting the attractive, high quality, high yield that clients are looking to extract from EM. But we're doing that in partnership with Gamma in such a way that we maximize the likelihood that we earn those yields and minimize the likelihood that it gets eroded by default, distress, price decline.
Chris, that is a great observation. Let's dive a little bit into how to invest, and we can just spend a few seconds here talking about identifying opportunities. First, I would talk a little bit about the corporates. That in corporate, what we look is like the balance sheet. What is the most important for us is the EBITDA, the revenues, the debt, the leverage, interest coverage ratio, debt distribution, net income. All those metrics are key for us, but basically it's like the ability of the company to pay the debt. That's what we're looking for. In government months, after all the macro analyze, this macro analysis, once we go all to the key points of the macro analysis, our process goal is to identify the relative value of opportunities in government debt. And for us, we use the C-score approach, which is pretty easy, but give us a sense of after we know which country we want to invest, where we want to invest in that part of the curve.
Gotcha. Hey, Santiago, as long as we're moving from theory into practice with some of these examples, I want to get your thoughts on one other thing that we mentioned earlier, like the influence of external relationships. By virtue of just proximity, US policy is going to matter quite a bit for the region, although we also know China has been expanding or attempting to expand its influence in Latin America. Even though we see a lot happening under the new administration here in the US, do you have any thoughts on what might be in store, where it might have the most impact? And you said you don't have nightmares, but what might keep you up at night?
No, great observation, Chris. I can use so many examples in here, but let's use just one that is going on the news lately. It's the Panama Canal. In numbers, 7.5 of the GDP for Panama. A quarter of the government annual income is explained by the canal. 55,000 jobs, which roughly would be like 3% of the labor force. Anyway, so many numbers I can throw here, just everyone knows the importance of the Panama Canal. Anyway, worst case scenario about the US taking over the Panama Canal, we're talking about 2 to 3 notches of downgrade. Nonetheless, nowadays, still investment grade. But, the yield in the market is trading as these downgrades has already taken place. Well, you'll tell me, but,
Yeah. I mean, so it sounds like there's a lot of wait and see, but being mindful that there are a wide range of possible outcomes here. As we start to wrap up here, Santiago, I want to come back to something else that you mentioned earlier. It's this notion of finding the best opportunities and employing a very active approach. The fund, despite being focused on ostensibly on one part of the world, does have a benchmark that is more global in scope. So how should investors be thinking about reconciling those two things, the focus of the fund, the global nature of the benchmark?
Great question. I will just share how we think about it. If you're going to use the MB Global Diversified, very large index, then you should expect a high tracking error. Part of that comes from the regional focus, and part of that comes from just saying that we focus on the best ideas and opportunities for the portfolio, rather than tie it up ourselves to a benchmark. From an investor's perspective, I think that is maybe a question on where it fits in the overall portfolio, context and the sizing. What are your thoughts on that, Chris?
Yeah. I guess I come at it from two different angles. First, if our tracking error owes to avoiding defaults and simply not buying things that we don't think have great value, then I'm all for it. And that's probably an appropriate way to invest in an asset class like EM, which is so heterogeneous. On the other hand, for where I see GAM as the most useful part of client portfolios, like either a higher quality and higher yielding replacement for some portion of their US high yield or credit exposure, or even as an alternative to EM equity exposure, but with a more consistent return profile, then what you should really care about is how GAM fits into your portfolio relative to those things rather than versus any stated bogey. And those same trade-offs of return potential, risk, diversification should likewise inform your sizing. So
Completely agree.
let's check in with the questions here. I do have one, which I actually just gave my answer on, Santiago. I'm curious to know what you think. From where should an allocation to GAM be sourced? Like, what should people be taking money out of to put into GAM? Does it make sense to take it from an investment grade bond allocation?
Well, to be honest, I'm not sure you want to answer first, but I have my own answer. And it depends. It really depends on the region of where the person sits at, right? Because, for example, US investors, I would say they would take it up from probably the high yield allocations.
Mm.
But investors in Latin and South America or Caribbean, they'll think it is as safe as keeping it in the bank, you know? So it really depends because it happens, you know, when we go to investors here in the region, you know, that they know the companies we invest, the same as your example you gave before. They know Disney, they know that, they know the companies that we invest, and they just, you know what, I'm all in on that. This is what you propose. Yeah, I know this company. I just go there and yeah, these are the guys. I'll go all in, you know. So for these kind of investors, they'll think this pretty safe, super safe, because it's the although it is the AAA of the countries, right? Although the rating might be double B minus or double B, but they know the company from inside out. They feel so safe about it. If you're talking about US investor, they probably don't know the countries, they don't know the corporates, and they probably put it or they take it out from the high yield investments.
Yeah, I think that's right. I mean, having been in EM a long time and recognizing that there are combined or overlapping elements of country risk and individual issuer risk, I kind of think it should come from high yield, given the way the portfolio looks today, just from a ratings perspective and from what we're doing. So that makes sense.
Absolutely.
The other question we got was on the currency positioning in the fund, not where the currency positioning is, but how you guys think about hedging. And I can guess how you're going to answer this because you said you're not playing for a big FX appreciation. That's not the goal here. But are there situations where you could go in, buy local, and hedge the exposure back to US?
No, we don't do that mainly because we're very comfortable with the risk. But we go from 20% risk of the portfolio to zero risk in the portfolio, or maybe we can go to 25, you know, but it's a limited FS risk, you know. But for example, now at this very point of where we are right now, as February 20th, right now I wouldn't mind, you know, taking position, you know, in FX in Dominican pesos. The government has issued the day before yesterday, the day before yesterday, like 3 billion of new money, nearly 3 billion of new money in dollars. So the central bank have a lot of tools and munition, you know, to just for the next 3, 4, 5 months to control that devaluation, I would say. So right now, I wouldn't hedge it. We're in those seasonality months that we don't need to hedge it, and we feel comfortable, you know, given also the interest rates that probably the central bank is going to auction next week, cutting 11% or 10.50 or 10, doesn't really matter where, you know, but with no FX devaluation or pretty much very low FX devaluation, we feel pretty comfortable, you know. If we're talking about the last auction in Dominican pesos for the treasury, cut at 10.50, So let's 10.50 for the next 2, 3, 4 months with a minimum devaluation. We feel pretty comfortable there.
Okay. Okay, I'm going to tell you that there may be somebody in the audience who is attempting to trade currencies as well, because I'm going to ask this question. Will LATAM countries have to lower interest rates and attempt to devalue their currencies in response to US tariffs?
Well, that's a great macro question. To be honest, and that's a little bit harder, because it depends country by country, But overall, I would say some of the main ones may have to do it, but some of the pretty small economies that are very attached to the US, they won't.
Yeah. I mean, I think it's one thing that's easy to overlook in all this talk about tariffs and countries responding with, we used to say competitive devaluations, is that can have very serious consequences domestically, right? I mean, you said this before, Santi, like these countries in some cases use FX as an anchor to set price expectations, right? They have inflation targets as well. Looking at this from the US, you say, well, who cares if they let the currency go? Well, they care domestically, because then everything they import becomes more expensive. Inflation potentially starts going up. It starts accelerating and getting out of control. So I think it will very much be there. I guess what I'm trying to say is there are push and pull factors here at play, and it's not as straightforward as just saying, well, the US wants more access to their market, so they want them exporting less to us. They respond with a devaluation because we put on a tariff. So
there's so many point of view there, on each country to do it or not, Obviously, if you devalue it, it would be a more competitive exporting, but not only to the US, also to Europe and to any other countries. But there's a certain risk in devaluating currencies in Latin America.
Gotcha. All right. There's one more question in the queue here. Are there any sovereign bonds that you are really excited about that you feel are severely undervalued? So you can pick your own threshold for severely, but tell us what you're super jazzed about.
Well, there's right now, for example, I like El Salvador for what it's coming, what it's doing. I like Argentina for what it's doing. But there's 2 or 3 in the right that I have that in the next months, I think we're going to see maybe next year. One is Panama, as I mentioned before, because it's trading already if it have these downgrades already, although they have challenges, macro challenges. Let's not forget about that. The other one is Honduras. There's elections taking place at the end of this year. And the other one that is a bit long term, and we have to really follow because political play as well, it's Colombia. They have elections in May 2026, trading at high 8s. Well, seems to be a country that we have to follow.
Gotcha. Okay. Fair. So we are just about out of time here. I want to thank everyone who set aside a portion of your day to spend it with Santiago and myself. We appreciate it. And Santiago, thank you for sharing your perspective on the fund and your thoughts on the region, as well as some of the details of your process.
Thank you, Chris. My pleasure. I always enjoy talking about my passion. And thank you for the Simplify team bringing me here and for all the audience.
If you have any further questions, certainly if there was something we weren't clear on, if we weren't able to answer your question today, reach out to the Simplify team. We are here to serve as a resource for you. We're super excited about pairing up with Gamma to run GAM. We think it is a unique and valuable product for our clients. Thanks again to all of you who spent some time with us this afternoon. And as a reminder, our next fund deep dive will be on March 20th, where we will get to talk about our latest addition to the ETF lineup, ETF with my favorite ticker, which is FOXY. That is the Simplify Currency Strategy ETF, where I will be joined by Ken Miller to talk about it. So thank you, everyone. Appreciate your time. Hope you have a great afternoon. Cheers.